Hello, welcome listeners and market participants, and welcome to KBRA's European Credit Podcast, Conversations in European Credit. I'm Gordon Kerr, Head of European Research at KBRA, and today I am joined by my colleague Luigi Griffo from our European Investor Relations team. We will be covering the topic of our investor survey, where we have solicited responses from across the European securitization market. It is our fourth version of the survey, and the results of this survey can be found on kbra.com, along with our outlook for European securitization markets in 2024. The intention of the survey is through 5 short questions to get a picture of the market. First, we asked investors views on the direction of spreads over the next 6 months. We asked them how they would characterize the current market environment. And we asked them about their view on the issuance pipeline and where they see things going in the next 6 months. Lastly, we asked them about their views for the markets that are likely to see the most collateral stress in the next 6 months. For our regular listeners, in this podcast, we are going to do things a little differently, although not that different to our other survey podcasts. My colleague Luigi is going to be sitting in my traditional seat and be the one asking the questions. So, Luigi, over to you.
Thanks, Gordon, for having me on the podcast again. I'd actually like to go straight into it. I think, as you said, we've done 4 of these now, so we're starting to build a little track record on what the expectations are, and we can kind of see how expectations have changed over time, which is always interesting. I'd start from spread performance. I believe on these, I think respondents had a pretty strong sentiment with respect to the direction of the market. So shall we start there?
Yeah, thanks, Luigi. In response to the question on spreads, it was actually quite positive, with a total of 50% that expect the market spreads will largely migrate in a tightening direction, while 19% feel that spreads will widen. A significant proportion, 31%, think that the market will remain unchanged. A small minority have taken the view that spreads will widen outright, which was only 2%, while conversely, a very strong number of 23% feel that the market will tighten outright. These responses highlight a changing sentiment from our June 2023 survey, with views migrating to a greater expectation for spread tightening in comparison to the previous survey, where there was a bit of concern with regards to spread movement going forward. Arguably, this is the survey with the greatest conviction amongst the 4 surveys completed to date that spreads will move in a positive direction. 1 year ago, in December 2022, 46% held a positive conviction for the market direction versus our 50% in this survey. And in June 2023, only 28% expected the market to do so. Views on spread movement expectations vary across market sectors, and survey respondents, investors and CLOs hold the most dominant positive expectations, with approximately 90% expecting spread tightening, either outright or marginally. Overall, most asset class investors have a predominantly positive view on the direction of markets in the early part of the new year. Other asset classes that hold a positive view on the direction of the market are other, classified as other, which is largely SRT investors. And 55% of ABS investors expect to see spread tightening, and 50% of CMBS investors. The limited investors that do have an expectation of spread widening are most concentrated in CMBS and MPLs, given the ongoing concerns surrounding these sectors. However, they are still overall in a positive direction. The types of investors with the strongest spread tightening bias are hedge funds and bank investors, and those categorized as other types of investors and pension funds are relatively well balanced in their views. Independent asset managers and insurance company investors hold, on balance, positive views for the market, but also contain a number of participants in those sectors that maintain a negative bias. Pension funds, insurance companies, and others hold largely the strongest views towards a widening in the market, again, albeit with a overall positive bias.
Thank you, Gordon. So in a more general sense, what's the consensus on the state of the market for the months ahead?
Yeah, most of those surveyed 42% hold the view that the market is largely going up and down, but will perform in the long run. And while a reasonably large proportion, 27%, view a relatively high risk of large negative moves, a small proportion, 6%, feel that the market is likely to just steadily plow on and ignore the movements in other markets. There is some degree of positive views on the current market, with 17% convinced the market is a steady positive performer, and only 8% view the market as volatile and really difficult to predict.
Okay, so given that picture that we painted now in terms of expectations for spreads and general direction of the market, what's the view on issuance for the months ahead and next year?
Yeah, this is where there's actually a really broadly positive picture as we head into the new year, which should give a number of market participants an uplift, as those surveyed overall view the issuance pipeline to be quite strong. The largest number, 31%, view the market as seeing moderate improvement in growth. A total of 21% see the market to have a strong and expanding pipeline, and 23% expect to see steady supply over the next 6 months. So overall, a very positive picture. Only 17% expect that the market will move back into the days of only prime collateral and largely retained transactions. And a small minority of 8% view the market as likely to be very quiet. In terms of the sector-specific views, they show a slightly different picture depending on the asset class. Investors expect to see an expanding pipeline in most sectors, with CLO investors the most positive for new transactions. 43% are expecting improvement, and 43% expecting a strong and expanding pipeline. Other sector investors are also positive on new issuance, with 75% expecting growth. ABS and RMBS investors also hold positive views that the market will continue to grow, with roughly 50% expecting expansion of issuance in some format. However, these investors also hold strong views about a return to prime and retention, with 14% and 26% respectively. Those investors with highest expectations for a quiet market are those with coverage in MPLs, with 29%, and CMBS. 17% view that it will either be quiet or largely retained.
That's very interesting and certainly comforting for all of us involved in this market to hear that at least the expectation is for a solid pipeline of issuance in the new year. So the next section of the survey, I think, was particularly interesting because we've always had a pretty strong view so far, but that seemed to have slightly changed with the last survey.
Yeah, when we asked investors which region they expect will face the highest degree of collateral performance deterioration over the next 6 months, the majority, 48%, expect to see deteriorating asset performance in the UK, which is down from the 70% that held this view in our June 2023 survey, and a still high number as well in our prior year, December 22 survey. Investors instead have been taking the view that the European market across the board is likely to see some deterioration, with 36%, followed by a small minority of a handful of countries, with Spain with 6%, Italy 4%, Ireland 4%, and a particular minority of 2% that viewed that none of the European markets will struggle. This is broadly in line with our views as we outlined in our European Securitization 2024 sector outlook, as interest rate rises and inflation cost increases are going to continue to place pressure on borrowers, both in the UK and across Europe. So while it is a positive migration for the UK, it does still demonstrate that there are concerns across Europe and maybe not necessarily so country specific.
Yes, hopefully the market will manage to escape any severe deterioration, as many are still struggling with those level of high inflation and high interest rate. So KBRA recently published the outlook for European securitization market. Did the current survey responses match with your views?
Yeah, in large part it did. While we do not necessarily comment on spreads, we did highlight that collateral performance is poised for some deterioration in 2024, with delinquencies expected to increase in particular sectors such as reperforming loans and non-conforming and buy-to-let RMBS. ABS sectors such as credit cards and consumer loans are also likely to face challenges, and refinancings are likely to test CMBS and CLO markets. The year ahead may start to see some tempered inflation, but also increased insolvencies and delinquencies as the lagged effects of cost inflation and rate rises begin to impact businesses and consumers, or continue to impact businesses and consumers. Geopolitical tensions also remain elevated and could disrupt markets next year, but the main key area of agreement between our outlook and the survey was the issuance pipeline, where we also expect to see an increase in 2024, where newly circulated transactions are expected to outpace retained transactions for the first time since 2019. As central banks cut back on support programs, a return to capital markets for secured lending will find appeal, plus a changing interest rate environment could find appeal with CLO investors, as highlighted in the survey, particularly around resets and refinancings. Cover a large number of topics in each of the sectors in more detail in the full report, which you can, of course, find on kbra.com.
It certainly makes for an interesting reading, particularly paired with the results of the survey. Thanks so much for having me on, Gordon. Before I go, I just wanted to thank all the investors that participated to the survey and helped us by sharing their views on what their expectations are for the year ahead.
Thank you very much, Luigi. Yeah, as you all can see, the current market situation is a dynamic one. In KBRA's previous survey in June 2023, there was a broadly divergent picture with expectations relatively split for the developments of the market and a pickup after a period of quiet issuance. This proved to be quite intuitive, as the second half of 2023 was both up and down with a good volume of issuance to recover from the quiet first half. In this latest survey, the tone has migrated more towards a positive bias, despite concerns about collateral performance, as highlighted by the migration of concerns away from a focus on the UK to a more broad-based concern across Europe. A particular area of migration is towards a more positive pipeline of transactions. This is in line with our expectations for the market in 2024, as discussed. Thank you very much, as Luigi said, to all of you that participated in our survey, and you can find greater detail in the reports on our website. Make sure you are registered to receive our latest commentaries and have subscribed to our podcast. And of course, please feel free to give us a review. And of course, you are engaged with our experienced analysts. Thank you very much for listening. We look forward to bringing you more conversations in European credit. Have a happy holidays and the best of luck to you all out there in the new year.